Welcome to Opto Sessions, where we interview the brightest minds from the stock market, uncovering their secrets to success. If you're looking for ideas, tips and techniques from the world's best, you're in the right place. Hello everyone, welcome to another episode of Opto Sessions. I'm your host today, Ed Gotham, and I have the pleasure of introducing Andrew Thrasher. Andrew Thrasher is the portfolio manager for the Financial Enhancement Group, an Indiana-based asset management firm. He's also the founder of Thrasher Analytics, a research and analysis service for financial advisors and investment institutions. We dig into the current market downturn, what to expect moving forward, and also touch on the US election, as well as going into sector rotation strategies, risk management, and planning for retirement. Enjoy. Hi Andrew, how's everything going?
Going well, getting ready to start this week off.
Yeah, it's been a very interesting week last week. Obviously, there's been some major moves in the market, particularly below key levels. What people have been talking about recently is about market breadth, and I thought if we could just potentially start there and get your opinion on why it's important and how you monitor sort of breadth in the market.
I think breadth is extremely important. We always have to remember, we often talk about and what gets reported in the media is whatever the Dow did or what the S&P did or whatever the index is, how they perform. But we have to remember the stock market truly is a market of individual stocks. And so by understanding what those individual stocks are doing, are they rising with the market, with the indices, or are they going down with the indices? Are they diverging? Whatever the majority of them are doing is going to end up having an impact on the overall indices. So I very heavily watch what breadth is doing. When we start seeing uptrends in the broad market, but then we start seeing less stocks going up, which can be measured through stocks above their maybe intermediate moving averages, like a 50-day or longer term moving average, like the 200-day, or purely just the number of stocks making maybe new highs or 3-week highs or 3-month highs, or however you want to slice and dice it, be able to evaluate how healthy is the internals of the market. And typically before major downturns, we start seeing kind of destruction internally where less stocks are being supportive of the overall market trend. And I break up, to kind of extend it further, whenever we see market downturns, I break it into kind of two different types of corrections. We either have sentiment-driven corrections, which I think is kind of what we're seeing right now, to where sentiment gets very, very frothy, everyone gets very bullish. You pretty much have everyone on one side of the proverbial teeter-totter, and that just needs a reset. Those types of corrections often are very swift, very severe, but they aren't 2007 type corrections. They're not dot-com explosions where you're seeing 30% drawdowns. They're typically 10% drawdowns. Whereas you have breadth-driven drawdowns, which is where you have less participation by the individual stocks, those are much more protracted. We saw that earlier this year in March. It was very much tied to the coronavirus, but going into the coronavirus in March, we really were seeing a breakdown in individual stock participation, and those types of drawdowns can be much more severe and can last a lot longer. So I think when we do see drawdowns in the market, it's important to see, is this being driven by sentiment or is this being driven by weakness internally of the market?
Sure. And so what would you consider what we're going through now then? This is more of a sharp, swift correction? Is that what you're implying? Or?
Yeah, I think this is more sentiment driven. A lot of the sentiment surveys were very, very high. The National Association of Individual Investment Managers does a survey every week of active managers, and they basically all were calling for a long bias. We're all net long, looking at some of the futures data, very, very high, 90+% readings and sentiment, and then also volatility, which I'm sure we'll get to later. So volatility had gotten very, very low and started consolidating. And when we get that compression and volatility, that's often a great barometer of very frothy sentiment from an option standpoint. And the VIX and that compression is something that I spend a lot of time on. I won the Charles Dow Award for my paper on that topic. So I'm sure we talk about that more later. But yeah, I think this was much more sentiment driven. Internally, we still had a lot of stocks that were in uptrends. A lot of stocks were still above their moving averages. And so we can obviously see a sentiment correction turn into one of a breadth type correction. But I think we started out right now, this was driven by kind of a resetting of sentiment.
And how are you monitoring market breadth? Are you just keeping track of the key sort of sector trackers? Is that sort of thing you're doing?
So I look at it from a lot of different angles. Primarily, I really like looking at the number of stocks above moving averages. One easy one is just the number of percentage of stocks above a 50-day moving average. And then is that trending higher or lower?
Okay.
It's not something that earlier this year when we kind of came out of March, we got above 90%. And then once we weren't able to get to that threshold, a lot of people were calling for divergence. I don't think we often need to continue to make new highs, but we need to see a lot of stocks still holding above that key moving average. If we have at least 60, 70%, that's still a good reading. But I look at that. I look at when the market's making new highs, when we started seeing the S&P hitting fresh 52-week highs, how many of the stocks were doing the same thing? I want to see the individual stocks trying to replicate what the market's doing and seeing that list expand, not contract.
Yeah. Okay. And into this sort of the highs that we saw recently before the downturn, you'd say the breadth was pretty low? There was only a few stocks that were doing the sort of all-time highs. Is that fair to say? Or?
I think that the big differentiator is the FANG stocks, the Facebook, Amazon's, Apple's, Microsoft, Google's, that index. They were the main drivers, I think, of the performance. But just because they were the strongest stocks doesn't necessarily mean they were the only stocks going up.
Yeah.
We still had a fairly healthy level of participation. It had broken down a little bit, but not nearly like we've seen before some of the more major corrections, like in 2018, before fourth quarter of 18 or March of this year. So I would still think that the breadth was fairly happy.
Yeah.
When you look longer term, like the percentage of stocks above like the 200-day, it was still very, very high. And so I think it was much more, like I said, driven by sentiment than by a really breakdown in breadth. Yeah, we had only a few stocks were the main drivers, and they equate to more than a quarter of the S&P at this point because they've been so strong. But I think that also relates again to sentiment, that we had such high sentiment for these few names to the point where their owners were making or losing billions of dollars every day based off what their stock was doing. I mean, that just kind of reads to the sentiment of the market that we got to that level of bullishness. Yeah. And now we're starting to see that get reset.
Yeah. Yeah. No, it's interesting times.
It is.
Can you give us a quick overview of what you do now and how you got to where you're today? Just a brief one, just to introduce people to yourself.
Sure. So my day job is I'm a portfolio manager for a financial advisory firm called Financial Enhancement Group. We work, act as financial advisors and money managers for primarily high net worth individuals and families. So my job is to manage those assets. Our advisors build these relationships with different families, and then myself and Adam Harder, we are the ones that then manage and are investing those assets on their behalf. So my day, all day long, is analyzing the market, looking for opportunities, doing trades within accounts, and then just there's some back office type paperwork that gets revolved around of doing trading.
Yeah.
But my main function is really managing those assets. I also run a service called Thrasher Analytics. It's a newsletter primarily for institutional, although some individual traders also read it. But it's my weekly thoughts on the market from a broader standpoint, from the sectors of the market to volatility. But I write that as well. But my main focus is really being a portfolio manager.
Sure. And I think it's fair to say you're sort of a technical analysis specialist. What led you into that area of, specializing in that area?
Sure. So I went to college and got a degree in financial planning. And so we took classes on investing through that process, but everything was really driven towards a more value fundamental focus on the market, looking for companies with deep moats. Think of a Warren Buffett-esque investment approach. And so when I started in the industry, that was really kind of the only way I knew about investing. And so you'd read Benjamin Graham, you're reading these key tomes of investment writing, and it seemed really complicated. My brain always went to a quantitative way to look at the market. I wanted to take kind of this value approach and how do I quantitatively look at the market through that lens, and it was really difficult for me to do. It was more squishy, trying to find companies that were undervalued. What did that even mean? And so I started just doing more research and learning about price action. And I realized that when you're buying a security, you're not buying it based off what you think it's worth. At the end of the day, it's what the market thinks it's worth. When you get monthly statements from TD Ameritrade, E-Trade, Fidelity, whoever the custodian is, they're not printing the values based off discounted cash flow. The values of your portfolio are based off what the market says that stock or ETF or whatever the investment is worth. And so that's what kind of got me down the path of trying to get closer to the market, which was really price. And then that led to technical analysis and then studying to earn my chartered market technician designation. And the rest is, I guess, history.
And if we take it back to the markets today, again, just because it's a very interesting time to sort of discuss them, I just want to get your insight into the major US indices at the moment. A lot of the world's sort of watching these as just indicators of where the market's going. And we've obviously, like we talked about, seen some pretty major sort of price movements down recently. What levels are you looking at the moment? Like how are you playing? What's setting up for yourself in the market? Based on where we're at.
Sure. Coming into this latest downturn, something that struck out to me was, so we have the S&P 500. That gets the most attention. That's the large cap index. We also have S&P 400 and S&P 600. That's the mid cap and small cap indexes. Before we really started seeing the markets turn lower for large caps, the mid and small caps, they broke below their prior June highs. They never even made it back to the February highs. But they were they were actually seeing not just relative weakness. It wasn't just that small caps and mid caps were underperforming large caps. It was they were on an absolute basis starting to turn lower. They weren't able to retain those uptrends. And so we're starting to see that breakdown in the market. And then we saw the large caps, the S&P 500, it broke back below its February high. That was a significant market move, in my opinion. We had this major breakout. We had recovered the destruction caused from the coronavirus crash in March. Equities rallied, and then we failed to hold that level. So that was kind of the first chip in the bull argument. And now we've continued to see the markets weaken. And then on Friday last week, we saw the S&P break below its 50-day moving average. And that was again another significant. This level had been support on prior turns lower since March. The 50-day had always kind of had held up. Buyers were able to kind of come back in and start buying that dip. So the fact that we closed them below it Friday, we saw it was options expiration, triple witching week, and then there were just too much selling that came in, forced us down below there. So where do I think we can go from here? I think it's very possible we could see a test of the 200-day moving average. That's right around 30. Let's see, where's 200? About 3,100 on the S&P is where the 200-day is right now. I think that's very possible. We're seeing some early market weakness when we're recording this today on Monday. And so I think I try to keep an open mind where I don't set an expectation to say, okay, this is where the market has to go. But typically when we do see these sentiment type resets that we're talking about earlier, seeing a test the 200-day is pretty common. Looking again at the other major index being the NASDAQ 100, typically we see that it's still about 15% above its 200-day moving average. It got really, really extended. And so typically when we see the market get that stretched, seeing it kind of come back and reset at the 200-day level is pretty common. I don't think that's a bull market ender or it's going to be the destruction or end of the world. It's normal to see markets correct. You you get these tests, maybe it'll hold, maybe that's what brings buyers back in and we can rally into the year end. I don't know. I keep an open mind to that. That's a possibility. But I think the 200-day is probably the next major, for both the NASDAQ and the S&P, the next major kind of line in the sand on the downside. On the upside, we need to recover that February high in the S&P 500. Patience can be extreme virtue in not trying to get caught up in kind of the whipsawing to where until we can really get back above that February level, kind of the 3,400-ish area, 3,420, and really hold it. That's to get really more bullish for me. I need to see that level recovered.
Sure. And do you think there's any chance of like any sort of prolonged sideways action between like some sort of range whilst this coronavirus going on, etc.? Is that also a possibility?
I think it's a possibility, but the one caveat that I think detracts from the idea of us seeing a range-bound market is one, volatility stayed persistently high. The market's expecting us to not have kind of a solemn, boring snooze fest of a market. Volatility staying very elevated. Skew is staying very elevated. We're still continuing to see an interest in deep out of the money options, which is what Skew is going to evaluate. It's sitting near multi-year highs. So the market's expecting higher levels of volatility. We also have a lot of catalysts that are going to keep stocks kind of pretty jumpy. We've got, like you said, the coronavirus vaccine headlines that seem to come out every couple of days. We got the U.S. election. Brexit's always popping back up. The issues with China. I mean, we have a lot of headline-driven market action. Don't throw in Powell, who's speaking 3 times this week. So we have a lot of headlines that I think is keeping the market from just having that sanguine, just sideways consolidation. Ideally, that would be great to see the market consolidate, prepare itself for the next leg higher. I would love to see that.
Yeah.
I just don't think we're kind of in the environment in 2020 to see a sideways market as much as we'd love just to have some boring price action for once.
Okay. And moving on, so that sort of relates to sort of volatility, like you sort of touched on it earlier. We obviously, like you mentioned, had triple witching on Friday. Which happens 4 times a year. Large options activity, obviously, expiry dates, which can cause volatility in the markets, and it sort of did. And how do you approach these sort of periods of high volatility? You actually mentioned before some of your analysis, you see correlation between downturns in the market and periods of high volatility where SP 500's at or near or like 1-year highs. Why do you think that happens, and how should people approach that?
So I think whenever we have triple witching, or really options expiration in general, the way I approach those time periods is knowing that on options expiration, we're going to see an increase in volume, there can be an increase in volatility, and I try to make less decisions on those days. And when analyzing the market after the fact, realizing that this was an important market event for the inner structure of the market, is kind of clearing the pipes with options as we shift to the next month. So I try to take those price action days a little bit with a grain of salt, unless we're seeing a major break, kind of like we did on Friday where we closed below the 50-day. But typically, specifically for options expiration in September, the week after, the week we're in this week, has historically been very bearish. Wayne Wiley did an excellent study looking at this week over the last 30 years. It's been up 6 times and down 24. So looking at the seasonality of kind of coming out of September option expiration is not great. So volatility, answering your question about when volatility starts rising, I did a study and wrote about in my Thrasher Analytics letter that typically when the market's at a 1-year high, and if the VIX is roughly 25% off its own 1-month low, so meaning you have volatility rising, you have equities rising, hitting fresh highs, things feel great, everyone's a winner. It gets really tough for the market to sustain that kind of pattern. When volatility is advancing, that's telling you something. That's telling you the market's expecting an increase in volatility. That doesn't essentially mean to the downside. VIX is non-directional. So when VIX is higher, it means the market's just going to have larger swings, potentially in both directions. But typically when we get more volatility, it's to the downside. And so what I found is when volatility starts rising with the market, it's preceded January 2018, preceded the March downturn here most recently. We've seen these periods to where the market began to struggle to go higher. And we're now seeing that play out again to where volatility began to rise along with the market. And VIX was who kind of won out that battle as equities now correct.
Yep. And on a sector basis, how are things looking at the moment? What do you think? Are there some that are, showing strength at the moment? Which ones are poised for better returns when the market sort of, whenever it does like turn around and start going higher?
I'm not in love with any of the sectors. Probably to speak broadly, I have a decent bit of exposure to technology, but more on an individual name basis. Can't get into those individual names. But I think it's really, the past couple of weeks have really set up, I think, for a great stock pickers type market. We've seen decisive winners and losers. And some great opportunities in some of the less popular names, which as a portfolio manager provides me with opportunity. From the sectors that I do think look okay, tech is really pulling back. I think utilities or anything that's interest rate sensitive doesn't look great. Utilities have yet to be able to really break out. Real estate doesn't look great. Materials has done well. It's held on to its strength. And there's been a lot of attention garnered from materials and industrials. Here in the U.S., we've seen a lot of strength in building. New home sales have done really well. Lumber prices skyrocketed from demand there and kind of a bottlenecking in supply. The issue there is when you take your sector look and say, okay, we're seeing sector rotation. Let's say we're seeing rotation from technology to materials. That's great. The thing is, materials make up 2.2% of the S&P 500. That's not nearly enough of a rotation to say, okay, well, the bulls will just sit in material stocks and the market will keep going higher.
Yeah.
Tech is 24% of the market. So when you see a rotation from technology to materials, from a sector that's almost a quarter of the market to one that's 2%, that's not enough of a rotation on a sector weighting basis to sustain a market uptrend. So right now, I think materials, industrials, they're held up the best last week. But we're so overweight from a weighting the S&P standpoint in tech and like consumer discretionary, which I think consumer discretionary also looks pretty decent still. Healthcare is kind of broken down, but the biggest weighting sectors, they're the ones that kind of had the biggest pullback because they were the strongest ones going forward. So even if you like certain sectors, they may do well relative to the market or on an absolute basis. But I don't think it's enough to really sustain the uptrend in stocks just because a couple material names or a couple industrial names move higher.
Sure. Would you say it's fair to say that the tech sector is so important now? Is everyone should be watching that as an indicator of direction of the overall market? Is it pulling the market in the direction whichever it moves?
Oh, very, very much so. I mean, like I said, technology right now is 24% of the S&P 500. Just those 5 stocks, those FANG stocks, replacing Netflix with Microsoft, just those names alone have such a large weighting that it used to be said that it's the tail wagging the dog. I think it's more now they've become the dog. Whatever those stocks do, the market responds. If Apple's down, for instance, if just on a day that Apple moves, it can be determined what the market's going to do itself just because it's such a large weighting. That's not necessarily a bullish or bearish argument against those stocks. It just shows the severity of their moves on the market, and you have to recognize that. To ignore what those stocks are doing and just assume because real estate's doing well, that's not enough. These names control the market right now. Apple did, and part of I think kind of the resetting we're seeing is we had the stock splits in Apple and Tesla, and now you have Apple's less of a weighting in Dow, and so it's going to have a less of an impact on the Dow stocks. But I still think the sentiment towards these names got very, very high. And so really watching, I built and watched an equally weighting of the FANG stocks, and it started to break down ahead of the market last week. And I was tweeting about that on social media, that the FANG names were making new lows, and that was kind of calling for the S&P to do the same thing. And that's what we saw last week. It was Friday, we saw that lower low because the market's pretty much chasing these FANG names. I think the bullish argument there is if the selling that we're seeing right now stays there, just stays in these 5 mega cap names, and maybe we can get some strength in some other parts of the market, then maybe that will keep the sell-off muted. But if the selling does start to bleed over to the rest of the market, we start seeing equal weighted indexes begin to break down, less interest in small cap stocks, and we start seeing some of the, like I said, the selling bleed over to the rest of the market, then that could kind of continue to light the fire for sellers, and we start seeing an expansion of selling and lower prices in the market. But right now, it really seems like they're keeping their sights set on those mega cap names.
Yep. And these tech companies, the sort of valuations we're seeing nowadays are arguably hugely decoupled from any sort of form of, traditional valuation metrics. Howard Lindzen recently said that valuations don't matter in 2020. What's your point of view on this?
I'll start with that. I don't look at valuations for how I evaluate the market. To that point, it's not that I don't look at it. It's just it's not something I ever really use. I think I have a ton of respect for Howard and think he's very, very smart. And I don't disagree with him here. I think part of the reason that we've seen this huge expansion in tech is because they're a little bit more immune to kind of they didn't have to shut down their restaurant during the lockdowns. They didn't have a disruption to kind of selling their products. Look at Amazon has been hiring tens and hundreds of thousands of employees because that's kind of where all the demand's going to these tech stocks. You're not going to stop using Facebook. You're not going to turn off your iPhone because you're on lockdown. So these stocks kind of disproportionately were able to benefit from kind of the disruption we had this year, more so than some of the other companies in other sectors. So from a valuation standpoint, they're the only ones that To some degree, we're able to make money over the last 6 months, or at least turn a profit on it. When you look at kind of the Q2 earnings, they made up the lion's share of net income for the large cap market. So from a valuation standpoint, no, I think the issue people get caught up with looking at valuation, if it's something you do want to pay attention to, is valuations can always go higher. If saying something's overvalued, it can be more overvalued. It's just the market's perception of what they feel like it's valued at right now. So I think if people are making entire decisions purely based off of a discounted cash flow analysis or a PE ratio, the market has taught this lesson numerous times that alone can always get more expensive.
Yeah. And someone else that's going to be really interesting coming up soon is obviously the US election. How do you think people should position themselves, for such a big event? And also, like, longer term, is it all noise? Does it matter who wins or loses? So what's a short and longer term sort of impact?
I'll give you my answer. You probably won't like it. No, you should not position for the election. We do get this question because we do work with our clients. They know the election's coming. They know how contentious it's likely to be. But in asking, should they be moving to cash? Should we get out of the market because of the election? Just wait for kind of the calm to settle. And we've seen time and time again with elections that the expectation is not always what the market delivers. When we had Obama get elected and took office in 2009, there was this expectation that it's going to be we're electing a socialist. He's going to destroy the economy. He's not a fan of Wall Street. And what did we see the market do? The market had an incredible rally for basically his tenure as president. Then we elected Donald Trump in the U.S. He doesn't know what he's going to do. People are freaked out. We saw the futures market responded, going limit down on election night. And then what did we see? The market was able to respond the next couple of months, and it was able to continue to rally. So regardless if it's Republican or Democrat, I think we need to be more focused on looking at the market itself than trying to look at these events and trying to flip a coin with how will the market respond. It could go either way in the first week after the election. Thankfully, that's not what we're investing for. We're not investing for just that week. We're investing longer term. And so, we have kind of a playbook set for corners of the market that we think will do well with under each administration based off what they're saying. For instance, Biden has been very, very hard on, much more focused on healthcare. And so kind of looking at maybe there's going to be some pockets of healthcare that will do well and that won't do well. Trump is much more for deregulation. So financial stocks may do better under that. And so there's different areas where we think each candidate may benefit certain parts of the market, but from a large macro standpoint, no, we're not making portfolio bets or decisions just because we have an election coming up.
Yep, fair. And even on a trading basis, is there any sort of do you just sort of de-risk for that period? So do not have, is that a fair approach to it?
Yeah. So something that I'm constantly watching is our beta. I want to watch the beta of the portfolio. So just how much market risk are we taking to the overall market? And so we'll lower beta coming into this downturn with lower beta just for that reason, just because we thought from a sentiment perspective, things looked really, really frothy. And so it's what I tell our advisors and we tell our clients, it's less about how much you own of something versus what you own. When you own a stock that has a beta of 5 and it's whipsawing all over the place like a toddler eating a bunch of candy, that investment is much different than maybe a stock that slowly grinds, maybe as a high dividend stock that doesn't really have a lot of connection to the market and is much less volatile. And so even though those are both equity allocations, you could own 5% of each of them, they're going to act much different and they're going to provide much different risk profiles for a portfolio. And so that's our focus is less how much equity exposure do we have, but the equity exposure that we do have, how much beta, how much risk do we feel those positions provide us, and then manage that part of the portfolio. I think going into the election, we're not going to move to cash, so to speak, but we'll manage beta within the portfolio and kind of evaluate how the market's acting going into that event. It won't be a kind of a closed-eyed approach and saying, okay, because it's election, we're going to do this, but we're going to see how is the market, or is it very jittery? Is volatility staying high? going to the election. Okay, then maybe we need to be have that taken into account for our risk management. But very much at the end of the day, it's market driven, not news driven.
Yep. Okay. And in terms of the dollar, are you keeping a close eye on that? And do you think that's going to be affected by the results of the election?
We do somewhat watch the dollar. We watch the dollar more from a standpoint on when we take international exposure. If we need to kind of have that be dollar hedged or not. There's different ETFs that are unhedged or hedged. So we'll look at the dollar from that standpoint. We don't make direct currency plays very often. Sometimes we will through ETFs, but very rarely are we making currency allocations. So yeah, I do think that there could be some implications from the election on the dollar. Again, thankfully, I don't need to be an expert in that. I just wait for the market to show me what is starting to strengthen the dollar. Because what we have to keep in mind is when we're looking at currencies, it's a pair. So it's the dollar to what? It's the dollar to yen, the dollar to the euro. We have to evaluate what's the euro doing as well. What's the yen doing as well? We'll look at currencies from like the Aussie, like the carry trades, looking at the Aussie dollar, New Zealand, and kind of see how those are doing, or looking at the yen for different carry trades as kind of a Forex risk barometer. But when you're looking at Forex, I think you definitely often gets overlooked. You have to look at what's it being paired to. So you can look at the dollar index, which is the average, but I think more insight can come from the individual currency pairs and what's the euro doing. When we saw the dollar get really strong, is it because one currency is getting really weak, or is it just because all of them are getting weak to the dollar? And kind of really evaluating it on an individual basis, just like we look at the market, the individual level of participation of individual stocks, you do the same thing with currencies. And is it the dollar is going up or down because it's strong, or is it going up or down because a bunch of other currencies are in opposite trends? And
I mean, globally, are you just interested in US, or do you have some exposure to, emerging markets or other sort of major international economies?
Well, I've never been more exposed to international than domestic. We always have a bias towards domestic markets. If we do take international exposure, which we do quite often, it'll be through ETFs. So we'll use ETFs as a way to gain that exposure. Our portfolios are built on ETF and individual stocks. So we don't use mutual funds, and we don't have futures or options within the portfolios for clients. So yeah, if we think China looks attractive, then we'll use maybe a Chinese ETF to gain that exposure, Latin America or what have you. But it's not a permanent part of the portfolio.
Sure. And that globally, is there anywhere that is looking interesting outside the States at the moment?
Not really. Right now, we're very minimally allocated towards international. We had some Chinese individual equities, but we managed those very, very tight stops there, just because of some of the kind of the news risk, and there's so much focus right now on kind of our relationship with China. We've seen kind of what's going on with TikTok and WeChat, and we're starting to ban companies and people.
Yeah.
So you have to recognize those risks are there when investing internationally. So right now we're primarily domestic focused right now.
Sure.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
If we could now sort of start talking about your portfolio management, trading strategy, etc. Starting with, what's your market strategy of how you sort of allocate capital in a nutshell?
Sure. So we manage several different portfolios, different models for clients. My main focus is called our tactical edge model. It's a little bit shorter term. We, as a firm, focus a lot on tax management and doing tax strategies with clients. So this portfolio is less focused on that. It's more risk focused, capital appreciation focused. And so the way I approach that model, since that's kind of what takes up most of my time, is kind of more of at the same time, a tops down and a bottoms up approach. And I'll explain what that means. So from a bottoms up, looking for individual stocks, there's different, I break that into two different types of kind of search criteria, so to speak. So one is looking for divergences, meaning stocks that have come down a lot and maybe we're starting to see, I think could revert higher. So maybe momentum is starting to rise or is not down as much, even though the price is lower. So looking for mean reversion opportunities. And then the other one is looking for breakout opportunities, stocks that are trending higher that I think will continue to trend higher. And the reason that I put these two categories are part of the model is the market often rewards one or the other at different times. So if we're really in a strong trending market, maybe those breakout type plays will do really well as strength begets more strength. There's other times where we start seeing the markets maybe are trading in a sideways range, or just we don't have a real clear trend direction, and then maybe mean reversion type plays work out better. And so by looking for both of those at the same time, it means I don't have to be right and place my bets all on one or the other. There's times where I have more allocated towards maybe trending stocks than mean reverting stocks, which is actually the case right now. But the model has kind of earmarked allocations for both of those types of investments. So that's kind of the bottoms up approach, looking, regardless of what the market's doing, looking for opportunities in stocks that are breaking out or stocks that we believe are going to mean revert and move higher. The other part is more of a tops down. So looking at the market risk and how much equity exposure do we want to have just to general market. Or maybe there's certain corners of the market, whether it's a uniquely built, actively managed ETF, or maybe certain sectors we want to be overweight in. And then we'll allocate towards those, but it's more of a kind of a tops down approach where we really want to kind of set our sails for our ship, so to speak, on which direction the market's trending. And then the third portion of the portfolio is kind of in alternatives. So we can own different maybe commodity ETFs, or maybe we want to have different cryptocurrency exposure there, or volatility exposure there. So anything that's really not your basic equity fixed income allocation, we have kind of an alternative sleeve, and that helps provide some diversification, provide a little, essentially diversification of the portfolio, regardless of what the U.S. equity market's doing.
Yeah. Okay. Sure. And you said one of your, I've seen one of your specialties is like sort of sector rotation strategies. In your words, what are sector rotations and sort of why do they happen?
Yeah, so we use sector rotation diligently every month in our other models that are a little bit more passive. And so it's an entirely quantitative process that we run at the end of each month to tell us which sectors we think should be considered overweights. And so the way I built that model is to looking at the idea of trying the best way to describe it without getting too complicated. So the markets typically do have a sense of momentum. So the stocks or sectors that do well continue to do well over various look-back periods. The caveat there is when something does too well, it's gone up too much. Let's think of like tech right now. Then it can get to the point where the proverbial rubber band is too stretched and needs to revert. So our sector rotation model looks to look at the continuation of momentum, that the sectors that do well should continue to do well. But we've built in a volatility component, a momentum component that will negatively impact the score of a sector if we feel like it's gotten too stretched. And there's been a lot of written on this type of topic. The way I do it is something I think is pretty unique. Won't get too far into what that is. But we try to combine kind of a momentum approach along with a little bit of mean reversion if a sector is getting too extended, and we have a pretty unique way of evaluating that. But we do believe in having some type of systematic approach to sector rotation. It's regardless of what I think of the individual sectors. It's entirely systematic.
Yeah. Okay. Sure. And how long do these sector rotations typically last when they do happen?
It can vary. So we do a reevaluation every month when we get our new sector scores, and we own a certain percentage of them at one time. And so some of them have been the ones that some of them could persist for several months or 6 months if they continue to receive the top scores. There's other times where we're constantly every month rotating in and out of new sectors. And so we don't really set it kind of an expectation of, as of September 1st, we're going to be in this XYZ sector for an X period of time. It's going to be in the portfolio until we do the next evaluation on October 1st. And maybe it will be the same sectors, maybe it won't be, but because it really kind of depends on the different market dynamics and what the price action's been. If it's a very fast market, maybe we see a lot more rotation. But it really depends. I don't kind of set an expectation to where this sector should stay in the model for 3 months or what have you.
Yeah. Okay. And in terms of risk management, obviously you're holding a portfolio of different stocks. Do you use diversification to reduce risk? And if so, how? I know you've just discussed that you like technology quite a lot. How do you make sure it's slightly diversified to minimize risk, or do you not employ a strategy to do that?
So the diversification that I look for is not diversification of assets, but diversification of process. The reason being, when you see, so the goal of diversification is to protect on the downside. It's to protect when the market turns lower, you're diversified and have assets that maybe shouldn't go down as much as the market, or maybe X part of the portfolio would do well when B part of the portfolio is not. The issue with that, and we saw it in March, and we see it all the time, is when the market turns lower, sharply lower, that correlation, which is what often people are trying to diversify, the different correlations of the portfolio, correlation goes to 1, meaning that the stock that maybe was a little bit what you thought was less risky than the market, all of a sudden starts moving exactly with the market. And your whole portfolio is now being controlled by, because it's all, the correlations totally broke down, and everything's being sold, thrown out with the bathwater, so to speak. So rather than look at correlation to find diversification, which is what a lot of investors do, what I look for is looking at process diversification. So I described earlier that I have different sleeves of the portfolio, different ways that decisions are made, and that's how we diversify. So when we're looking like the individual equity portion, if we're looking for mean reversion stocks, that process looks entirely different than the process we're looking for trending stocks or momentum type stocks. And so if the market starts rewarding one sleeve more than the other, that's the diversification we're looking for. And so by having diversified processes, it's less reliant on what the market's doing and more understanding that these processes have different inputs and produce different results. And maybe ideally they will perform better than others at different parts of the market cycle, but it's less reliant on what the market itself is doing. And that's the type of diversification we want to look for, because that's the type of diversification we can control. You can't control correlation, it's dynamic. You can't control beta, it's dynamic. And so that's really hard for a manager to do, even though that's the popular way to do it in academia. And we see a lot of papers written about an efficient market hypothesis and all that gobbledygook. But in practice, it really has left a lot of people wanting.
Yep. And when trading, lots of people talk about having a sort of per risk amount per trade, a percentage of your portfolio. How do you approach overall risk in the portfolio if you have multiple trades open? Is there a total amount you sort of allocate? Or
yeah, so we'll start with a kind of a baseline allocation, like if we're talking individual equities, where it's a pretty small starter position, was what we'll call it, based off kind of the perceived risk of that investment. So if it's a stock that that's very volatile, that's often in the news a lot, then maybe and just it's a little bit harder to manage. Maybe there's not clear-cut support resistance levels on the chart. Maybe we'll have a smaller allocation to those types of stocks, whereas the risk reward going into maybe a new investment maybe is a lot stronger. It's a less volatile security, so we feel comfortable taking on a larger weighting there. And then we'll build positions from there. So if we start a position, let's say at 2%, and it's acting well, we want to continue to buy that strength. We'll reward, so to speak, the stocks that are doing what we want them to do. They're going higher. So we'll add to that position. I'm much less of a fan of buying stocks that are not doing what I want them to do. It kind of goes back to the value mindset of if you love the stock at 100, you'll love it even more at 80. Well, no, that's the market telling you you're wrong. That's the market telling you that when you loved it at 100, you were wrong. It went to 80. That's okay. It's not a bad thing to be wrong, but don't reward that stock in most cases for telling you that you were wrong. So I like to reward good behavior, not bad behavior. So I'm much more inclined to add to winning positions, not losing positions.
Sure. And that makes a lot of sense. In terms of you touched on, but a lot of your sort of portfolio management or side of it is to do with planning for retirement at the firm you work for. How do portfolio strategies change over time as individuals move closer to retirement? How does that sort of work?
Yeah, so our advisors meet regularly with our clients, and so what they're doing is creating financial goals with those clients. So maybe one family's goal is to be able to pass money to a foundation that they've worked a lot with, or maybe give it to a school that they went to, or to a child, or what have you, or it's, most of the time it's planning for retirement, and so they want to make sure they have enough resources when they retire, or they're actually in retirement already, to be able to provide income for while they're in retirement. And so by setting these goals, it's much less, you'll notice I didn't say anything about they want to do better or worse than the market. That's an irrelevant goal. Our clients, you're not rewarded from outperforming the market by 10%. What you are rewarded for is trying to meet your actual expectations and your goals. So our advisors use that when they meet with clients. Say, okay, here's what your journey, your financial journey is going to look like to meet these goals, these expectations. Here's what I think we need to have this much risk within your allocation to be able to achieve that type of goal. And so we'll say if somebody's very conservative, they have shorter term focus maybe for this money. Maybe it's money that's been set aside to pay for a grandchild's college education in 2 years. Well, maybe we don't want to take on too much equity risk there. So we put it in one of our more conservative models, conservative portfolios that's more geared towards fixed income, so to speak, or a little bit less equity exposure. So that our advisors are constantly having these meetings evaluating what's the purpose of this money and how much risk, how much is the focus more on appreciation? Do we need to help grow it? Or is it more in preservation? We want to protect it in the sense that it's not so much we need to grow it, we need to make sure it persists, it lasts, it preserves itself for a long period of time. Maybe it's money that they need in a shorter period of time. So our advisors are doing those conversations. And then they're selecting the models to put those clients in, and then myself and Adam, we then are then managing those portfolios based off the kind of the risk profiles of those clients.
Sure. And is it possible, so sort of later in life, when you're looking to reduce risk, is it still possible to look for some sort of growth without taking too much risk on board to, risk significant drops in your account, which you can't afford at that stage?
Yeah, so I think we're always trying to manage risk first in everything we do. And so, like I said earlier, we take a focus on taxes as well. We don't want to be generating, if it's a regular individual account, we don't want to be throwing off a ton of short-term gains because those aren't overly tax advantageous here in the US. At the same time, if it's an IRA and it doesn't have tax issues on a year basis, then short-term gains are relevant for that type of an account. And so we'll take that into consideration with what type of model to use, if it's more short-term focused or long-term focused from a tax perspective, but also the drawdowns matter. We want to, it's much harder to recover a 50% drawdown. You have to recover 100% to get back to even. And so we definitely take that into consideration with how we manage risk. And we'd rather protect on the downside and have to give up a little bit of upside potential to make that that investor's experience a little bit better, in the sense that if they have less volatility in their portfolio, there's less emotional response to that. And studies have shown there's going to be more likely to sustain that strategy and to sustain their plan for the future than to have an emotional response saying, get me out, move me to cash. There's a lot of people that did that in March. Thankfully, our clients weren't one of them, but a lot of other advisors had their clients emotionally respond to what was taking place. And I think it's because the conversations they were having with their clients were more performance driven, where how are you doing relative to the market, rather than the conversations we have with our clients, which are more goal oriented. So when our clients call in and are concerned with the market, we are able to go back and say, remember, we have this plan in place. Here's what our goals are. We're still on track with those goals. Maybe we can make a few tweaks here and there so you can sleep better at night, but being more goal focused makes the conversations and chance of having a successful financial future much more obtainable, or much closer, easier to be obtained.
Yeah. And we've seen an explosion in sort of interest in the markets, particularly in the younger sort of demographic, through the sort of success of Robinhood, eToro, things like this. But it's still very common, I think, to find people that don't really have an idea about how to approach investing, especially for the future sort of thing. How do we get people interested in this from an earlier stage, do you think? Do you have an opinion on that?
I think part of that wall, I think, has come down now that we have free trading. So there's less a lot of the brokerage firms now offer transaction-free for trading. I think that helps bring some of it down. So you have it's less daunting that I have to spend X amount of dollars to do this trade. At the same time, by making it that easy, it almost makes it more like gambling. I think the first thing we need is more education in school systems. The fact that you're learning esoteric concepts in some high schools that are never going to be applicable in the real world, but we're not teaching anything about personal finance. Students start getting credit card applications, but don't know anything about debt management. They're taking on maybe hundreds of thousands of dollars in loans for college, but have no idea about what their credit score means. Or they go into their new job and they're told to sign up for a 401k. They have no idea what retirement planning is. And so I think it's important that we really need to educate from a high school standpoint, from a high school point, really about personal finance. And some schools are doing this, and I think that's great. But I think learning early on what investing is, what personal finance is, creating a budget would vastly be important for so many students and would really help them further down their life, be able to manage when those important topics come to bear.
Yep. And you also touched on something very interesting there. This concept that, free trading has opened up the market, but has also made it potentially more risky for people because it's too easy to buy and sell. What do you think are the longer term effects of that? Are people going to ever get over that thing, or is that an issue where people need to learn basically how to approach things when it's that easy to go in and out of the market?
Well, I think we had a very unique year this year in the sense that we came into with a lot of the brokerage firms offering zero transaction fees. We then had the March crash, and then it's kind of been this environment where it's believed, kind of tongue in cheek, that stocks only go up. They have nowhere else to, gamblers have nowhere else to go when sports stopped. So they came to the stock market. We saw an explosion in options transactions from a retail standpoint. We really saw a lot of gambling because the perceived risk in the market had been taken away. So they thought, because stocks would only go up. And so I think we're if we do see a protracted downturn here, it'll be an important lesson of whenever it occurs. The market's not going to go up forever. So whenever we do see a protracted market downturn, now that we have all these people that are newly interested in trading because of kind of the strong move off that March low, I think they'll be able to kind of learn some things about risk management, which are important. And some people have to learn those lessons through their own accounts. Some will learn it through reading about other people's accounts and money that's been lost. But I think we're seeing kind of as part of the buildup in sentiment that we talked about at the start of the show was from a retail standpoint. They were seeing either themselves or their neighbors making a lot of money buying calls on electric vehicle makers and quitting their jobs as dentists to trade full time. I mean, those types of anecdotes are out there. I hear them from other people, and that's not typically a good thing. We don't want to see your taxi driver pull over to the side of the road so they can close out their call positions. That's a little bit of froth in the sentiment standpoint.
Yeah. Awesome. And I just wanted to finish now with something we call the quick fire round. It's just 6 questions. You can ask them and just, not looking for a long answer, just whatever comes to mind, basically.
Sure.
Favorite book? And this can be investing, non-investing, anything.
Okay. The books I think that are some of my favorites, the Market Wizard series are excellent. Most recently, The Man Who Solved the Market, about Renaissance technology, was very, very good. Those have been some of my favorite ones. Technical Analysis, I think How to Make Money in Stocks by William O'Neill was very, very useful. Those are 3 probably of some of my more favorites. The Market Wizards and Man Who Solved the Market were fascinating reads, and I recommend them quite often.
Thank you. And where or who do you go to for market insight, if anyone?
Yeah, so there's a lot of traders that I talk with, some more than others. Some of my favorites: Dan Russo, JC Peretz, Thomas Thornton, Ari Wald, Joseph Family does great, Brian Shannon, Jim Bianco in Chicago is great with more economic type stuff. There's a lot of financial Twitter and social media, and there's a lot of bloggers that do excellent jobs providing insight. And I'm lucky enough to call a lot of them good friends.
Perfect. And a top tip for your younger self?
Take more risks. I'm a pretty conservative from a risk standpoint, I think just by nature of being a portfolio manager. And I would say to maybe push the envelope a little bit more when I was younger. Be curious to see what how life would have turned out if I had.
Yeah. Favorite charting software?
Probably Optima. I'm a really big fan of Optima.
Optima. That's a very common one. I find a lot of people on the podcast say that. Favorite place you've traveled and why?
Favorite place probably would be Italy. Loved Italy. My wife and I were there a couple years ago. I love wine, and so being able to go to Tuscany and see, and also Rome and seeing the Amalfi Coast. Just there's so many beautiful places in Italy. Loved Italy. Would move there if that was a realistic option and I could trade the U.S. markets there. Would love to live in Italy for 6 months if that was an easy thing to do. Love Italy. And
finally, have you got a top prediction for next year? Where do you think we're going to be at?
No.
No.
No, I don't. I truly do, and it's easy to say no. I truly do try to keep an open mind to it. I think when we get set an expectation of a price target or an earnings price target, I think that even if it's done flippantly, it does create that mindset where you've put something out there and you get attached to it. So by not having one and trying just to be fluid with the market, I think has so many advantages. So no, I really don't have an expectation going forward. I'd like to see the market go higher. That's always it's a better environment, especially as a portfolio manager to see appreciation. But I don't set that as my expectation. Try to keep an open mind.
Sure. And actually something, I'm just going to add a question in here because you mentioned something earlier that was quite interesting. You said some of the exposure is in cryptocurrencies. Have you got an idea? What do you think longer term about cryptocurrencies? Are they going to sort of just generate more traction, or where do you think this is going?
I think they're extremely, from a personal standpoint, I think they're extremely interesting. I think there's so much potential we could see come out of the crypto blockchain, and they're two different things, but we'll kind of tie them together. I think there's a lot of potential for blockchain that's going to be used, and I don't think that's ever going to go away. I think it'll be adapted from healthcare records. There's so many things that could be done through the blockchain. Aside to crypto, I think there's just so many things that are interesting about it. From not just from an investment standpoint, just from a global forex, we're starting to see countries are developing their own cryptocurrencies. The U.S. Fed has come out and said they're planning on coming out with their own cryptocurrency. So I think there's so much potential there. It's extremely volatile, as we've seen throughout the years. But I just think I'm really curious to see in 10 years looking back what happens in the crypto blockchain space.
Yeah, no, I agree with that. I think it's really interesting. Especially there's a lot of new interesting cryptocurrencies now coming out, new ones that have different sort of use cases, etc. That it's just going to be quite fascinating how the world sort of adapts and starts using those. Brilliant. Thanks so much, Andrew. That's been such a good hour chat with you. For anyone who wants to find out more about you and follow you, where can they go?
Yeah, so my main blog is athrasher.com. I write a subscription letter at thrasheranalytics.com. I'm on Twitter quite a bit at Andrew Thrasher. And then my firm's website is yourlifeafterwork.com. That's where I manage assets.
Amazing. Cheers, Andrew.
Thank you so much.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest to you. Opto Updates is our short newsletter sent every day during a trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new podcasts, stock reports, or events from the Opto world. If you're interested, sign up using the link in the show notes. Until next time.